So, Dave, welcome back to our interview. We just said we want to discuss your global focus. You're a global investor. Why are you that?
Okay, the stock market is a very interesting place. I mean, there are people who believe in efficient markets. We think there's lots of empirical evidence as well as logic to say the markets are anything but efficient. People are sometimes rational, sometimes not so rational. As part of crowds, they can become very irrational from time to time. And that gives us opportunity to find bargains. We wait for the market to make mistakes. Now, it's not easy looking for those mistakes, so the greater the opportunity set, the more likely we will be able to take advantage of a mistake. So why not look at the whole world? Why not look at all the market caps? And so that's what we've done. We've maximized our opportunity set. So all countries, all regions, all industries, all sectors, all market caps. And usually there's one of those things that the market is skittish about, and that's where we can buy really good companies at bargain prices.
Do you say that you don't invest in certain countries, or are you doing all countries?
Well, we are willing to do all countries. Now, we might be willing to take a 10% discount here in Germany, but want a 50% discount in Russia and maybe 90% to be in Venezuela or something like that, where we don't currently have anything. So at a price, we'll consider anything.
Do you like a certain market at the moment especially?
Well, we like good companies at good prices, and right now the market is willing to give us good prices in Korea. They're willing to give us really good prices in Russia right now. They're willing to give us good prices in Ukraine and here and there in China, places like that, emerging markets in general. So we don't try to have a preconceived notion of where. We just our utility analysts will say, I'm finding a bargain here, and our phone company analysts will say, I'm finding a bargain there, and the railroads will find somewhere else, and then we find from the bottom up that we right now have a third of our portfolio in emerging markets, and we have well less than 10% of our portfolio in the United States. Now, we love the United States, but the market really, really loves the United States, and so they're paying the highest prices ever. So we're finding way better, risk-reward scenarios elsewhere, and especially in emerging markets, and especially in Canada. Canada right now has a lot of those companies I talked about earlier with gold mining, with uranium mining, and special situations.
What qualities do you look for in certain companies?
One thing we try to look at is one industry being different than another. Now, I know a lot of people have industry specialists, as we do, but we start with our very first thing we do when looking at something is an industry template, where we're saying, what is this industry all about? What are the barriers to supply? If somebody starts making money, will supply flood in, or are there barriers to keep it out? Then we say, what is the winter likely to look like? Is this an industry where it makes sense to borrow money, such as a hydroelectric dam? Or is it an industry where borrowing money is often the kiss of death, like technology? And so we'll say, is the balance sheet appropriate for the business? We'll say, how good is the management team? And also, how important is the management team? If we were to own Nestle's, which we don't own right now, we would consider management to be only partly important, but it's such a great franchise they have that an average manager could do okay. Where we look at smaller companies or turnaround situations or highly leveraged situations, then we'll say management is very, very important. And so once we've looked at all those key variables, we identify the companies that we want to be long-term owners of. Now, once we've identified that, then we say, how are we going to value this? We look at a lot of metrics, or we value it on replacement value or liquidation value or book value or earnings, and come up with our price. We risk adjust that price based on the things we talked about, what we think about the industry and the geopolitics. And if it's gone through all that and we still like it, it gets onto our approved list. If it is not gone through that, it cannot be bought in anybody's portfolio. Once it's in the portfolio, then we say, how cheap is it relative to what we think the risk-adjusted price is, and we put in an appropriate position.
How many companies are you currently watching or on your watch list?
On the approved list are over 100. In the portfolio is about 70 right now, and then our team of analysts is always looking for more.
And how big is the turnover of a company? Do you have certain holdings you have from the beginning of your funds in there, or?
Yeah, our turnover is pretty low, but if our turnover is 25%, that would suggest every 4 years things turn. But it's a couple important points. We have some names that we hold for a long, long time. Others that quickly run up and approach our price, we'll sell. There's no need to hold it if it's already reached our price. Another thing is we seldom buy a company and then sell it. We'll say, let's say a company is worth 30 in our mind and we could buy it at 20. We don't buy at 20 and sell at 30. We buy a couple percent position at 20. If the stock goes up to 23, we're going to take it down to 1.5%. 25 or 6, we'll take it down to 1%. Drops to 17, we'll take it to 2.5. So lots of little trims and adds. So that's another important. And then a last important point, times like 2002 and 3 and 2008 and 9, when the market was just horribly volatile, that was a wonderful thing for a value manager, an active manager. So our turnover, both of those periods, were closer to 100%. We were able to buy a bunch of growth stocks after they fell 80 or 90%. We were happy to do that. So turnover depends on opportunity.
Does this trading add return?
Add return? I think it adds a lot of return. It's especially been helpful when value's been so out of favor. We've been underperforming in this market, of course, but we've done a lot better than the value sort of things that we're in. Say I mentioned gold stocks that have dropped a lot over the last half dozen years. Our gold stocks have gone up. Our energy stocks have gone down, so we're not perfect, but we've done better in emerging markets than the emerging market indices, better in gold than the gold indices. So if you've got stocks that are fluctuating up and down, I don't know why people consider that risk. That is opportunity. And so we have definitely added a lot of value.
How is your performance linked to the performance of value versus growth?
Value versus growth, I don't know that it's that linked to. We've, over our career, done very well in value markets and done very well in growth markets. What we have done horrible in is momentum markets, just the wild that we had in '99 and the wildness you saw last summer and again on the first quarter. We grossly underperform in those environments, and then fortunately we usually do quite well when the momentum breaks. 2000, 2001, 2002 were really great years for us. 2016 was a great year. Fourth quarter was okay, and so we look forward to when this momentum breaks, which it seems inevitable to us.
Do you have something to add?
Not a whole lot to add. I think it was a great conference here, and it was interesting to see the views on whether quality growth is the new value or whether it should be more the Graham and Dodd old value, which we're more in that camp. But a lot of smart people here with a lot of great views, and we think right now will be really great for value in general. We'll see.
Do you see opportunities in Europe?
Yes, opportunities. We find the U.S. to be way overvalued, and we find Europe and Japan to be quite interesting, and we find emerging markets in Canada to be unbelievably cheap.
Emerging markets in Canada.
Emerging markets and Canada, they're both very cheap. Canada because of the resource dominance, and emerging markets because they're not growing as fast as they used to, but they certainly should grow faster than Europe and the U.S., and yet you're not paying for growth. A lot of these companies we look at are single-digit PEs, fractions of book value, and so we like growth at a non-growth price.
Do you also do tech?
We do tech. We did a lot of tech in 2002. We did a lot of tech in 2009. Not a whole lot of tech right now. Tech is very loved right now.
Thank you very much for the interesting interview.
Well, thank you very much. Good talking with you.